Could we all please be seated? Mr. Rajneesh Kumar, Chairman, State Bank of India and Chief Guest of today's function. Mr. Sanjeev Sanyal, Principal Economic Advisor to the Government of India and the keynote speaker for today's event, and other respected dignitaries and invitees who have come for this function. Good evening and welcome to you all. We will be starting now. I firstly request the Chief Executive Fedai, Mr. Ashwini Sindhwani, to please escort the Chief Guest, Mr. Rajneesh Kumar, to the dais. I now request Chairman Fedai, Mr. H.K. Jannah, to please escort keynote speaker, Mr. Sanjeev Sanyal, to the dais, please. I request Mr. Sindhwani to please welcome Mr. Rajneesh Kumar with a bouquet as a token of our love and affection of Fedai. I now request Mr. Jannah to present a bouquet to Mr. Sanjeev Sanyal as a token of our love and affection and a welcome to Fedai. I now request the Chairman Fedai, Mr. H.K. Jannah, to please give his welcome address. Sir.
Good evening to all of us. Respected Sri Rajneesh Kumar, Chairman, State Bank of India and Chief Guest for the today's function. Sri Sanjeev Sanyal, Principal Economic Advisor to the Ministry of Finance, Government of India, and the keynote speaker for this evening. We have top functionaries, the board members, managing directors and executive directors of various banks, and deputy managing directors and other senior functionaries of State Bank of India and other other banks. We have dignitaries from ex-deputy governor and managing directors of RBI and other banks. We have representation, we welcome them from various organizations, FIMDA, FIBIL, FI. And ladies and gentlemen, I am happy to welcome all of you for the third annual day of Fedai. It was the inaugural function was in 2016, wherein we had Dr. Raghuram Rajan was the keynote speaker and Mrs. Arundhati Bhattacharya was the chief guest. So we have been continuing with this program, and I think market looks forward to this day or evening, and this will certainly provide a lot of clarity so far as market functioning is concerned. Our guests today, chief guest Mr. Rajneesh Kumar, is a well-known figure in the financial market. So many times we have ups and downs in the financial market, and whenever probably market would be struggling to find some direction and clarity, his statements do provide that. So I welcome you, sir. I welcome Mr. Sanyal, who has a multifaceted personality. He is an economist. He has worked in the market areas. He is now the principal economic advisor. He keeps a lot of interest in the environment. He has done quite a lot of work so far as the interpretation and going into the analytical portion of the Indian and world history. We have seen at least some economists in historians, but we have seen a great economist, a great historian in this economist. So I welcome you. I don't want to take any further to be in between the chief guest and you all. So I welcome you all. We have a wonderful evening in store for us. Thank you all.
Thank you very much, Mr. Jana sir, for that brief welcome speech. I now invite the chief guest of today's function, Mr. Rajneesh Kumar, Chairman, State Bank of India, to please come and deliver his address.
Mr. Sanyal, Jena, Mr. Sidmani, ladies and gentlemen, a very good evening to all of you. Let me first thank Fedai for inviting me today for this third annual event. When I see the audience, there is so much experience sitting here that I consider myself honestly to be novice. I have worked in State Bank in India for 38 years. But this is one area which I consider to be my weakest, because I have never worked in the treasury. And we have Mr. Khan, Praveen Gupta, they all are, Mr. Shiran, they all are veterans in treasury. So giving a keynote address towards this, to this august audience is really indeed a very difficult task. But let me first compliment Fedai, who have been playing a very long and valuable role in the development of the Indian foreign exchange market, and as a self-regulatory body for the forex industry in India, it plays an invaluable role of filling in the necessary expertise and ground knowledge in the regulatory process. Indian financial markets, all of us are very keen observers, and 2018, it has been an year of turmoil, where we have seen that there has been a huge spike in yields, which how much was related to the actual fundamentals, that is still something which is a subject matter of debate, and particularly the way the yields have gone up in India, and the spread between the repo and the 10-year yields probably has never been so high in the past. But I believe that 10-year yields today represent more what is happening on the ground. The factors, again, all of us know that the reasons, more than the domestic, it has been the international developments that is having an impact and bearing on the yields in India, be it the strengthening of the dollar or strengthening of the crude price, which has impacted exchange rates, which has impacted 10-year bond yields in India. And hopefully, and all of us are very optimistic that on all these two fronts, there is now some normalcy returning. The crude oil prices have come down almost by $20 from the peak. There is a stability today as far as the exchange rate is concerned. There is a stability even on the dollar bond yields or the US interest rates. And while earlier it was widely anticipated that the rates were moving in US also only in one direction, but there seems to be some pause, and that is definitely a good news as far as the Indian bond market is concerned. As far as the banking sector in India is concerned, again, the sector is showing signs of definitely some recovery, if we look at the results of the banks for the September quarter, most of the banks, they have been able to show a relatively better performance as far as the asset quality is concerned. Very few banks, 2 or 3 public sector banks, they have not been able to still show the control over NPAs, but otherwise in terms of fresh slippages, gross NPAs, net NPA number, the improvement is a welcome improvement, and it has been helped by turnaround in some of the sectors like steel and cement. It has been helped around by greater discipline which has been brought by what I consider to be one of the most significant reforms in the Indian banking industry, which is the reform around the introduction of bankruptcy code in 2016. We could have had better results, there is no doubt about it, but the process, and particularly the judicial process, when the law is new, the processes are new, all players are new to the system, we have to give some allowance at least for some initial delays. But as the law is getting settled through the various pronouncements which are coming from the highest court, even today we had one more judgment. So with all these pronouncements, the scope for litigation hopefully will get reduced. The credit growth, the number seems to be fairly good, and 14% YOY growth in credit. It can be considered to be a good growth, although we are not seeing any huge private sector investment as far as the large project goes, but because of the revision in commodity prices which have gone up, the demand for working capital has increased. The investment in infrastructure, which was the key driver of the growth in the last, not last, but the earlier period of 2008 to 2013-14, that growth is still largely driven by the government spending, and any major large investment in the projects by the private sector is yet not on the cards. The rupee depreciation, it did help to cure the overvaluation which was indicated in the real effective exchange rate for some time, and the latest round of depreciation had started to create worries for not just the foreign investors but also the economy as a whole, given our almost inelastic dependence on the imported products like oil, electronics. Electronics I would still not consider to be so important, or where we cannot achieve self-sufficiency. Oil we can't do much or anything about it. And as I had mentioned earlier, that with the normalcy and stability returning to both the currency markets as well as the bond market, if we can have a stable period even at around these levels, this will not then be any major concern for the economy or the growth of the economy. And all of you, the market participants who are present today, I have been given a quote. I have not read this book, but this is a written quote of Warren Buffett. You have to be open to a possible change of course if you get new information. And that is the need of the times. And with the speed of information traveling really fast in this mobile and digital area, we should be open to quick change as well. And definitely I agree with this statement that the entire economy worldwide and in India, it is undergoing such a huge paradigm shift which we don't really realize or appreciate because we are part of this change and part of this age. But if we just reflect back that how much has happened in the last 10 years, the development has been amazing. And when the economy globally and in India, when it is changing so fast, then nothing can remain unaffected, be it the currency market, be it the stock exchange, be it the debt market, fixed income, new ways, new methods, new channels, new products, new demands, they all are emerging, and we must capitalize on that. Innovation is the order of the day, and maximum innovation as on date is in fact happening in the financial services area. And I am very sure that Fedai, all its members and Fedai will seize upon all the new things which are happening and will be in the forefront of leading the change as far as the foreign exchange markets are concerned. So I wish you all the best, all the members. If last year was probably not as good, but I wish that the new year which is coming, it should be very good for all the members of Fedai. Let it be a very profitable and prosperous year, and let us make it a year of innovation. Thank you very much.
Thank you very much, sir, for that informative and very knowledgeable speech, giving us a perspective on Indian banking and its status today. I now request our Chief Executive, Mr. Sindwani, to present a memento to Mr. Rajneesh Kumar as a token of our gift, appreciation, and love and affection of Fedai members. We in Fedai do several activities throughout the year. There are several people who contribute to those activities and excel in those activities. We take this annual day as an opportunity to try and recognize them and honor them. And we are going to take the advantage of Mr. Rajneesh Kumar sir being present here for doing that. The first thing is we have a certificate course in foreign exchange, which is a mandatory course required to be completed by all treasury personnel. This is conducted through IIBF, and we are honoring the topper for the May 2017 exam. Now, this exam has been taken by roughly about 30,000 people till now. The May 2017 exam, 3,300 people appeared for it. And the topper is Mrs. Sri Kumari from Federal Bank Limited. So I invite Mr. K.N. Srinivasan, because I understand Mrs. Sri Kumari could not come today. So can we please have Mr. Srinivasan? Yeah. Thank you, Mr. Srinivasan, for having come on her behalf. Please convey our congratulations to her. The second activity that we had was a market survey, where we had asked people to predict the levels as on 30th March 2018. We took three parameters. One was the RBI repo rate as on 30th March, the BSE Sensex level, and the dollar rupee INR level. People were required to predict those rates. And in that, we have the winner, Mr. PTVN Pradeep of City Union Bank. Do we have Mr. PTVN Pradeep or anybody from City Union Bank who can come on his behalf? The first runner-up is Mr. Sarvanan R. from HSBC Bank. Could we please have Mr. Sarvanan? Anybody from HSBC who can please come and receive it on his behalf? Now this is an all India thing, so many of the people are from outstation, so they may not have been. The second runner-up is Mrs. Geeta BM from Vijaya Bank. Okay, we again have a representative coming. Thank you. Then we have, all of you may be aware that we have Fedai books, which we have on foreign exchange, on the trade, and we regularly update those books. In this year, we have reviewed them and completely revamped them after having a subcommittee of Fedai, which suggested the various ways in which we can change it and make it much better and more relevant to today's needs. A lot of people have contributed from the member banks, but we have two people who have retired, who are not serving staff of the member banks, and have still contributed and have contributed a lion's share. So we would like to honor them. Mr. Arun Gharat, who has retired from Canara Bank, could you please come up? He is based out of Mumbai. Thank you, Mr. Garathan. Can you please wait on the dais? We then have Mrs. Neeta Chavan, former trade product head from ICICI Bank. Yes, sir. Thank you very much for your contribution, ma'am. Could you please stand? So now we will be releasing the revised Fedai books. Okay. So there are 6 books. We will, please come. Yeah, so there are 6 individual books, each from 1 to 6. Please, each one of you can please unveil those books. Thank you very much, sir. I now request today's keynote speaker, Mr. Sanjeev Sanyal, Principal Economic Advisor, to please come and give his address.
Mr. Rajneesh Kumar, Mr. Jena, Mr. Sindhwani, Mr. Khan, and my dear friend, Mr. Chauhan. Ladies and gentlemen, good evening. And before I go on, let me say that in case you were hoping that I was going to give you any deep insight into what is going on right now in Mint Street, let me say I'm going to disappoint you because I have no idea. It is a special pleasure to be here at Fedai because I started my career not very far away from here. I used to work for a firm called Crosby, which later got taken over by Societe Generale, the bank. And it had its office maybe 100 or 200 meters from here in Nariman Point in Maker 6 on the 4th floor. From then I moved on to working for many years in Deutsche Bank, which used to have their office in Fort, in a very beautiful building next to Sterling. So in many ways, I'm back in very familiar territory, and in fact, I have spoken at Fedai events before, and perhaps the first time I did so, this was back in 1998 or 99, and I used to work for Deutsche Bank, so since I worked as an economist for a European bank, everybody thought that I actually understood what the euro was about. So I was asked to come in and give a talk. And I was about 27, 28 years old. And so I actually didn't have a clue. And so anyway, I read up about it and I got a presentation in from our head office and read whatever I understood and gave a speech. And I was quite frightened that somebody would ask me a very difficult question. But it turned out that nobody in the audience had a clue either. So I got away with it. But hopefully we are all now older and a little bit wiser. And my purpose here was, I thought what I will do is, rather than look at very short-term events of the last few months and looking into the near future about events that are happening or about to happen, which in any case, Mr. Kumar has anyway given you a much better overview than I could ever do. I thought what I'll do is I'll step back several steps and give you a class in economic theory. And I hope to keep you awake through that too. Now, the reason I think this is important to do is because not only is our economy changing very rapidly, but we are doing it at a time that the very field of economics is going through very radical changes in its theory, in its practice. And I thought I'll give you some sense of what is it that we are attempting to do in the context of Prime Minister Modi's vision of a new India. How does all this add up? That's basically what I intend to do. And then hopefully towards the end I will connect it through to some of the things that are more directly relevant for foreign exchange and financial markets. So the basic idea of what Prime Minister Modi is attempting to do in terms of when he says we're trying to create a new India, the basic idea is to move our politics and our economics for one that is based on patronage, rent-seeking, and personal relationships to one that is based much more on frameworks of rules, is based on innovation, is based on social and economic churn, and effectively one that leads us to an economy that is much more fluid. But all of this has to be done in the context of a field of economics that is itself changing. So I'm going to take a few steps back and tell you how does the economics that we are attempting to apply different from what has been the conventional economics that has been, you may have learned in your textbooks or read about in newspapers, and so on. Now, the economics of the last half a century, whether it's socialist economics or the free markets economics of the Washington consensus type, is based essentially on Newtonian mechanics. That's why most economics that you hear about will use terms like equilibrium, liquidity, levers of fiscal and monetary policy. Now notice all of these are essentially mechanical engineering terms. And this is not very surprising because it comes from a worldview that the economy is some gigantic machine that is running along this fixed line call it the trend line. And the basic idea of macroeconomics is that you're running some sort of a Victorian steam engine where if it is going too fast, you pull the brake and it slows down. And if it's going too slowly, you shovel more coal into the engine and it goes faster. Now, this framework of thinking of economics does have some interesting insights. But the problem is that the economy is not a steam engine. What if instead it is actually a evolving ecosystem that is continuously being buffeted by shocks, technological shocks, geopolitical shocks, domestic political shocks, economic shocks of various kinds. And in this sort of evolving, fuzzy world, we have to make policy, and you have to try and manage your risks, and hopefully be able to have a functioning business. Welcome, ladies and gentlemen, to the world of unintended consequences, black swans, butterfly effects. Now, in this chaotic, complex world, how do we make policy? Notice that this is not a world that lends itself very nicely to equilibriums. It is not a world which lends itself to terms which still pop up in policy making, like this is the natural rate of interest or the natural or neutral rate of unemployment. As the Fed has in recent years found out, there's perhaps no such thing. What do we now do? So it turns out that 21st century economics has begun to think of all of this in a completely different way. Because the old way of thinking was based on the idea that we were dealing with completely rational human beings, and that these people had to find a optimal equilibrium, and everything was about trying to find this optimal equilibrium. Now, if you happen to be a socialist, your idea was that there were some wise men sitting in the planning commission who knew where this optimal equilibrium was, and it was all a matter of herding all of us in that direction. The free marketeers of the Washington consensus view were of the view that this optimal equilibrium worked, and if you allowed everything to function, it would naturally end up in this optimal equilibrium. But, as I pointed out, suppose there is no such optimal equilibrium, and suppose people are not entirely rational. In fact, the entire idea of rationality breaks down when there is no obvious equilibrium to aspire to. So how do we make policy, and how do human beings and companies generally, or other economic agents, institutions, etc., make policy in this environment? It turns out, and there's lots of evidence now of this, that human beings and companies, institutions basically make their policy by using heuristics. Now, that's a complicated word for basically making rules of thumb. That's how we actually make policy, not by making very rational choices, but essentially by using rules of thumb. So how do human beings arrive at these rules of thumb? Well, there are many ways, but there are two very basic and important ways. One is by trial and error, learning by doing, feedback loops. And the other way they try and do this is by simply looking around themselves and looking at context. They react to context. So this context could be the cultural context, it could be the context of rules in which they find themselves, and so on. So human beings are hugely swayed by this. This is why the same Indian who will go to Singapore or London and so on and drive very carefully and follow all the rules will land back in India and drive like a lunatic. I know this because I do it myself. So context matters, and ability to learn from trial and error matters. And I'm going to try and show you how both of these have fed through to the kinds of reforms we have tried to do and the way we have implemented them. So let me show you a few, I'll show you through a few examples. Let's see how many of you actually own a dog. Let's see. Yeah, how many of you own dogs? There are quite a few owning dogs. Okay. Now, what many of you will do is you'll take your dog and you'll go to the park and you'll throw a frisbee. Now, The dog will run along with the frisbee and catch the frisbee. Now, if you happen to be a traditional economist, that is not how we would go about it. What you will do is you'll first go to the park and you'll measure the speed of the wind. Then you'll do a lot of research into the breed of the dog. And then you will look at the design of the frisbee, the angle at which you will throw it, the strength of your muscle strength at which you will throw it, and all of that you will then feed it into an Excel sheet. And then you'll run this Excel sheet many times around, and then you'll come up with a forecast. And then if you happen to be a policy maker, you'll take the forecast and you'll give it to the Frisbee Policy Committee, which meets once in 2 months, and then which will then give you forward guidance. And taking that forward guidance, you will now carry your dog to the park. You'll fix a stake in the ground, tie your dog to it. You'll go back to the back and throw the frisbee. And the frisbee will fly, and 99.9% of the time, it will land somewhere else other than where your forecast said it would. And your dog will completely miss catching the frisbee. Now, the only person who would be surprised by this is the economist. Meanwhile, all Norman people are throwing the frisbee, and their dog is catching the frisbee. So the question is, how do all these other dogs catch the frisbee? The way all these other dogs catch the frisbee is by doing the following thing. Their master broadly says in which direction the frisbee is being thrown, and so the dog goes and broadly sits there. So you get a broad indication from the dog owner. And then the frisbee is thrown. And then the dog runs along with it, looks at the frisbee, runs along, looks at the frisbee, longs along, and at the end when it's coming down, it locks in and grabs the frisbee. So what is the dog doing? What the dog is doing is feedback loop and adjust. Now, does it sound somewhat like how we introduced GST? When we introduced GST, we had been already debating this for 20 years. In fact, when I was at university, we were debating this because it's pretty obvious that we have a large country and we have an absurd situation where it's easier for Mumbai to trade with Shanghai than for Mumbai to trade with Delhi. So we had been talking about some sort of a unified indirect tax system for a long, long time. And of course, I grew up in Kolkata, so you can imagine we really debated it. But having debated it all this while, when we finally came down in 2019 to actually begin to implement it, everybody said, no, you're not prepared for A, you're not prepared for B, you're not prepared for C. But the fact is, when you're introducing a major change into a complex country like India, the problem is that you will always have unintended consequences. You will always have butterfly effects. There is no way to actually implement it and find out what will go wrong. The only way to do it is to actually implement it. So we, knowing fully well that it was unlikely to work in the beginning, we introduced it, and guess what? It didn't work. So first 3 months it didn't work, but we took feedback and we fixed it. After 3 more months, it sort of worked. 1 full year later, it by and large worked, and a little bit more than a year on, we have a GST system that works reasonably well. If we had waited to fix every single thing that we thought would go wrong, we would probably still be trying to fix it. In fact, none of the things that actually went wrong were the things that the experts told us would go wrong. Nobody told us that the thing that would not work in all of this was going to be that the export refunds would get stuck. Nobody told us that the thing that would not work in the website was the error correction button. The only way to have done it was to have done it. And so, one of the learnings of the new economics is, if you want big changes, make a broad plan, but then just introduce it and fix it along the way. Now, this looks very messy, but it gets the job done. And this is the only way to introduce very major changes. The most critical part of this, however, is that we need to keep our ears open as policymakers to what is happening on the ground and continuously adjust to it. What doesn't work is to have a big ego and to say, this is the grand plan and we are going to implement it whether we like it or not. We will implement big things, knowing fully well it may not work in the beginning, but we will make changes along the way. So that gives you a broad idea, one example of how we change things. Let me give you another, let me talk about the other thing, which was the issue of context change. As I told you, human beings heavily get derived by context. And one of the major problems of India has been that we have had a business culture, the context, where one of the problems was we had very poor creditor rights. Now, this was not just a problem for the banks, it was a problem for the whole business culture of the country, where what mattered was how much of resources you could grab and then you could milk it for rent seeking. Now, before 1991, it was a matter of grabbing large amounts of licenses. After 1991, we realized that the resources you grab and milk are things like coal licenses, 3G licenses, but one of the biggest ones was take large amounts of loans which were not really expected to repay. Now, that was a context that had big implications for our business culture, and we had to change it. Now, we knew, we always had a banking problem, and this culture was a long-ranging problem, but it particularly became bad between the period 2006 and 2013, when a large amount of credit was created. A lot of it by 2013-14 had gone bad. And we knew we had to do something about it. And indeed, Governor Rajan, one of the things he did was to force recognition. So in 15 and 16, as you will know, the banks had to go through a very painful process of recognizing many of these loans. Now, the question is one thing to recognize, but what do you do with all these bad assets? So by the end of 2016, it was pretty obvious that we are forcing through all this recognition on the banks, but we had to do with all this bad NPAs adding up. Now, the conventional thinking was that what we should do is to put all of this into a bad bank, and then the bad bank would keep sorting it out along the way, and meanwhile you recapitalize the banks and they go back to lending. Now, this would have in some ways been less painful, but it would not have changed the business context. Instead, we probably would have ended up with yet another taxpayer-funded institution like BIFR. Basically, a bad bank is a tax-funded warehouse. And there are many examples of this in the rest of the world. You have, for example, in Indonesia after the Asian crisis, they created a bad bank. And guess what happened? Not surprisingly, the same old businessmen and promoters bought back their assets at 20 cents to the dollar. There was no change in business culture. So if you wanted to change business culture, what should you do? So the somewhat brave decision was taken to actually apply a completely brand new mechanism, a brand new set of rules to change context, which was the Insolvency and Bankruptcy Code. But remember, this is early 2017. We just have a new law. We have no procedures, no precedents. We don't even have an LCLT bench. So it required a lot of political courage to decide to actually try to use a completely untested thing to begin to clean up our banks using it. But there was one good news, which was just 50 cases accounted for 2/3 of the problem. So we reasoned that even if the brand new system wasn't able to solve hundreds of thousands of cases, at least it could solve 50 cases. And so we identified 50 cases, and I have to say my colleagues in the Reserve Bank, particularly Viral Acharya, who had originally been an advocate of the bad bank idea, he changed his mind and he went along with us. And so we identified these 50 cases, in fact, specifically identified 12 cases, which we then took through the system And as you know, there's 180 days plus 90 days, so the 270-day period passed somewhere in the middle of 2018. And one by one, we have begun to now, whatever, liquidate, auction, or whatever happens to be the consequence of the NCLT process. In my view, quite apart from the large sums of money that seem to be recovered from the sale of some of these assets, which I'm sure Mr. Kumar will be quite pleased with, the biggest achievement of this is not just the money. The biggest achievement of this is that we have successfully changed the business culture of this country once and for all. And so, just as GST may have been chaotic and complicated in the beginning, but eventually created a framework of rules, in the same way, IBC has now created a framework of rules. When we started introducing IBC, as I pointed out, we weren't sure where this was going. We made it up along the way. Just like the dog watching the frisbee, we watched what happened and adjusted along the way, as we have seen many ordinances and rules, etc., changed along the way. We were doing it because, frankly, we were learning on the job as well. But we swallowed our pride. At no point in time did we try to act like we really knew where it was going. We saw what was going on, we adjusted, occasionally we backtracked. That is how and only way we can do big changes. But the net result of all of this, ladies and gentlemen, is that as a country, we have managed to introduce these huge changes that I can tell you, you will be telling your grandchildren about. It's done. And while we can keep adjusting it and improving on them, this GST framework, this IBC framework will still be used 100 years from now. Now, this comes to another framework that we introduced, which is much closer to home for you, which is the introduction of a monetary policy committee to essentially create a framework for how we manage our monetary policy. This too is a very radical change. Remember, we have historically been a fairly high inflation country. Not high inflation in the Latin American sense, but a high inflation country where it was quite routine to have inflation in the 8 to 12% range. Sometimes it would fall somewhat below that, some point we might spike above that, but by and large, it was not unusual for us to have inflation just short of double digits. And that's how life was. We all took it for granted that we could never really aspire to be a low inflation country. Now this is actually quite a painful thing in multiple ways in a country where a large proportion of our population is so poor that they do not have inflation hedged assets. So this is a non-trivial problem for a country like ours. So again, a very brave decision was taken to create a monetary policy framework using flexible inflation rate targeting model with a target for inflation at 4% with a 2 percentage point range on either side. And again, nobody really knew when a country like ours would suddenly impose something like this and whether or not what impact this would have on inflation. And it turns out now that we have now had this for a while, that we have actually done a pretty good job. That the inflation rate has now by and large been in that range, in fact, not usually in and around the 4% range. And the only time we have actually breached this actually is on the downside, not in the upside. And so, as a result of this, we have managed structurally to lower our inflation rate by something like 600 basis points. This is a massive achievement. Most countries attempting to do this would have had a severe recession. And yet, we have managed to do this with some cost perhaps to our growth rate, but still remaining the world's fastest growing country. And ladies and gentlemen, you have done it because much of the pain must have been felt by many of the institutions that you run. And yet we did it. And it is now done. Our structural inflation rate is running now at 4%. But let's also be clear that as a result of this, we did pay the price in many ways. One of the ways in which we paid a price is that our underlying real interest rates have jumped up very, very sharply. And this is a very major issue. particularly for medium and small enterprises who continue to borrow somewhere in the range of 12% to fund themselves. Now, it was one thing to be borrowing in those kinds of rates, even slightly higher, when your inflation rate was 8-9%. Quite a different thing to be borrowing at 12% when you have an inflation rate of 4% with an 800 basis point real interest rate. In fact, even the sovereign borrows now at 400 basis points. So this structural increase in real interest rates is something that we have paid for, and we need to now begin to unwind, because it was perhaps needed during the adjustment period, but it is something that we and our colleagues at the central bank now need to seriously think about as far as how we begin to structurally lower our underlying interest rates to align ourselves to the new level of inflation. And this is important at multiple levels, and here again the new economics comes back. The conventional view of economics on interest rates is that it is a one-way street, i.e. higher interest rates lead to lower inflation. Yes, if you're only thinking in the very short term, but in fact, interest rates are an input. Capital is an input into production. Higher interest rates increases the cost of borrowing and therefore increases the cost of production. So if you structurally keep inflation rates high for long periods of time, it means that you are not creating the capacities or infrastructure and other things that you otherwise would have. It means that you are increasing the cost of production. So keeping high interest rates in the long run actually causes high inflation. Again, remember the feedback loop. This is the second order impact of interest rates that we need to think about. So if we want to remain a low inflation country in the long run, ironically, we actually need to structurally lower our real interest rates in the long run as well. And this is something we need to do, and of course, in that context, we also need to manage the wider context of liquidity and so on for this. And this is something that we will all have to work together, because it's, of course, about bringing policy rates down, but it's also about bringing down the big disintermediation price that our financial system also seems to demand. So bringing down the cost of credit delivery has to be a very important part of this story as well. Now, there is another price we have paid, which is on even closer to your hearts, which is that of how we manage our foreign exchange and exchange rates in this new context. Now, in the old days, supposing the rupee came under pressure, one of the ways in which we managed it was by spiking up interest rates. Now, as many of you will know, one of the problems of one of the laws, or you can say, of economics is something called the impossible trinity. The impossible trinity condition basically says that once capital flows of international capital flows are free, you can either manage the exchange rate, or you can manage interest rates, or some trade-off between them perhaps. But basically you have to make some trade-off. You cannot simultaneously, independently manage your exchange rate and interest rates. Now, when we introduced the MPC and the Monetary Policy Committee and gave them a clear mandate of managing inflation, we effectively opted for monetary policy. In effect, we therefore said that we could no longer use our monetary policy directly for managing our interest rates. Monetary policy now had to directly think of one thing, which is inflation. And yes, to the extent that exchange rates in an indirect way affected inflation, they could think about the exchange rate, but in direct terms, they had no business thinking about the exchange rates. Now, this is very different from how many people may think that we should be managing our monetary policy. But we have made this option now. We may change it in future, but for now, the current MPC, the way it is set up, basically targets inflation. It cannot consequently directly target the exchange rate anymore. And so this means that you have therefore ended up in an environment where the exchange rate becomes naturally somewhat more volatile than it used to be. And not just in a unidirectional way as you may have been earlier used to, but in a bidirectional way. Now, this doesn't mean that we don't care about exchange rate. We still do. But we can't use our monetary policy to do this. So we can maybe use foreign exchange reserves. We can do other steps to encourage capital inflows, FDI, portfolio flows. We can think of, encouraging NRI deposits, whatever it is. But we cannot use monetary policy directly to mess around with exchange rate anymore, as long as we maintain this framework. This is something I thought I should be very, very clear about, because very often whenever I debate with people who work in foreign exchange markets, they go back to talking about, in year 1999 or whatever, 2007, we faced a similar position, and governor so-and-so hiked the interest rate. We can't do that anymore in the way we used to. So then comes the question is, what do we do then under these circumstances? And so it comes to making a big judgment about how we use our foreign exchange reserves. So now we have to think of our foreign exchange reserves pretty much the way armies think about their ammunition. Is this the correct level at which to fire the cannons or not? How much of the ammunition do you use to smoothen out volatility? And this is a judgment call. This is not science, it is art. In the recent few months, when we saw the exchange rate suddenly switch from last year, remember, we were in a position where we were appreciating so strongly that our big problem then was that the US government was looking to actually paint us as a currency manipulator. And then a few months later, we had the exchange rate falling very, very quickly. So it was a big swing from going up towards 63 and suddenly heading towards 74. And along the way, the central bank had to make judgments about where to do. So there were certain points at which they did sell down some of their reserves. It happened, I think at 69 or thereabouts, they did some, then some along the way. But they made a judgment that they wouldn't use too much of it up. Maybe they did the right thing. I think maybe they were not too wrong to have used up all the ammo at a time where the pressures would have basically meant they were used up their reserves and achieved very little, and they kept their ammunition dry. I think they broadly did the right thing. I have somewhat different views about whether or not they should have reverse sterilized the impact on liquidity, but certainly I do think they broadly did the right thing on the exchange rate front. But we do have to still think about other ways of maintaining longer-term capital inflows into the country when we face these kinds of situations, and making sure that these capital inflows remain relatively stable. And obviously, the most stable of these is FDI, but there is very few monetary things or financial market things that we can do. That is got to do with broader issues of ease of doing business, the size of India's market, and so on. So it is really a portfolio of flows that we are here, that we may be interested in. And in this context, again, we need to think about how we make sure that portfolio flows are much more stable. Now, this is a very long discussion, obviously, but certainly we do need to begin thinking about how we make sure that India is included in and maintains its share in various global indices that provide for much more stable flows, whether in equities using MSCI and other such indices, or in the bond side with Citibank and JP Morgan and other indices. And I think this is something where we do need to apply our mind. And I think we have not done ourselves justice in this, partly because many of the things that stop large inflows into these index-based funds are sadly technical issues that we have not cleaned up at our end. So I think this is an area where we in the government are now paying attention, and we hope that we will be able to try and pay attention to this much more strongly. The other thing is, of course, to improve the wider ecosystem of our markets. This is particularly true for our corporate bond markets, but also for our government markets. And in this context, again, there is one big problem, is that we do not have a sensible risk-free yield curve. Now, you can't be a civilized country and not have a risk-free yield curve. Now, there are many things that need to be done in this. Some steps were taken. Sadly, so far, it hasn't really worked. So we have continued into a somewhat strange environment where we have a government paper yield curve which is liquid below 1 year, and then it has one liquid point at 10 years, and everything else is kinked and changed shape and is a liquid. And anytime you have to do some pricing, it's basically some model somewhere, and you know what I think about economic models. So basically, it's an opinion. And so we cannot have this as being the basis of a thriving fixed income market. And we recognize this, and it is something, again, on which we really need your help. Because I would love your feedback. There are many things that we need to do on this. I have discussed with many of you. We need to obviously do various things in terms of, we have started doing a little bit of it, which is targeting various different points on the yield curve and issuing paper there. We need to do a lot more on buyback and switch. We need to have a liquid and sensible swap market. And so all of these things are things that we have now applying our mind seriously, and obviously also with our colleagues at SEBI and at Reserve Bank of India. But obviously, again, feedback from you as we go through this process. It may not work the first time around, but as you know, we are dogs chasing the frisbee, and we will take feedback and adjust along the way. I've now spoken for a very long time, and I know it's 8 o'clock and all of you are hungry, so I'm going to stop and maybe for the next 15, 20 minutes, perhaps answer a few questions that you may have. Thank you, ladies and gentlemen. So should I? So if there's a mic here somewhere, anybody wants to ask a question? Yeah, there's a gentleman right in front who would like a mic. There's a gentleman there as well. Okay, and there's a gentleman here as well. Yeah, please.
Yeah, you said that the whole thing we are shifting from, in fact, earlier it was something where we are talking about more, we are tolerating higher inflation. Now we're talking that we have shifted from a higher inflation to a lower inflation model. That's very great, but in adjustment, there is a section of society which gets a lot of pain. How we are going to deal, especially when the price is not there, especially because the producers, whether it is farmers or industry, because they have a time lag, what they buy, they are able to sell at a higher profit and money is there. Yeah. So especially from the farmer's side, which is, looking at the fact that by numbers they are very great, how will we meet that?
So I fully agree with you that this adjustment, particularly the fact that during the adjustment process, both liquidity and real interest rates have obviously spiked up, has not been entirely painless, and the people who have probably faced the most pain of this, farmers maybe, but also small and medium enterprises. And farmers are also small enterprises and entrepreneurs in their own right. So anybody, small and medium enterprises of all kinds have been paid in some ways, felt the brunt of this adjustment. Now, yes, in the long run it's great, but in the adjustment period it has been painful. And not surprisingly, this in many ways is the nub of a certain discussion going on still in Mint Street. This is a central issue to the government. We are aware that our partners in the SME sector who have felt this pain now and felt a credit crunch now for 2 full years as we have gone through many of these adjustments, GST, cleaning up of the banks, even when they were not at fault. I mean, it may have been a large company that was going through the IBC, but they were, because they are operational creditors to it, or they happen to be suppliers to it, or whatever it is, as the network of suppliers went through a change, and at the same time the system was going through a squeeze, there has been an issue. And we recognize this, and this is one of the reasons why we feel that we need to pay special attention to this. You know that a scheme has been recently launched by PM Modi. We'll see how that goes. But this is a central issue to us, whether it was related to making sure the NBFCs can carry on lending despite the recent credit squeeze, whether it is PCA banks, but very importantly, overarching all of this, the idea that while we are carrying out all this major cleanups, we cannot continuously have this idea that we are going to introduce ever stronger capitalization norms on our banking system. This is, at some level, the debate, why we entered into the debate about why we think it may be inappropriate to have Basel III plus. There may be other problems with Basel III, by the way, which we are not even getting into, which is not a part of this particular discussion today. But even if we accept that Basel III is a globally accepted norm, we feel that Basel III plus is perhaps overdoing it. The same thing similarly about PCA banks. We cannot have a Hotel California approach to PCA banks, that you can check out any time you like, but you can never leave. So, we have to have a plan about how these institutions come out of PCA. And so all of this is related ultimately to making sure that credit flows through to the bottom of the system, because it's no point in having this highly capitalized central bank and a highly capitalized banking system, none of which actually supports the financial requirements of the lower half of our economy. So this is a very vital question you've asked. We are very much...
So just a follow-on question, if I can. Mr. Sanil, what would be your view that the two sectors which we are talking about in a country like ours, where SME and agriculture, they are ultimately mass employment, and any economic activity or any economic planning ultimately has an objective of employment. So what is your view that if we can be tolerating a little more higher level of percentage of deficit budget, so that
of the what budget?
Budgetary deficit by the government.
See, I have to say that budget is the binding constraint of this situation now is not the fiscal. The binding constraint is credit flow. Let us solve the credit flow problem. Trying to solve a credit flow problem using a fiscal means is expensive and inefficient. So let us not end up with a fiscal problem trying to solve a credit problem. So I would argue we are clear about where the issue is. Let's focus on it and solve it. Yeah.
We are so much dependent on oil, and the moment in oil prices impact our trade deficit, growth, inflation, etc. Is there a thought process in the government to build oil reserves, especially in a medium term? I understand there could be challenges around physical infrastructure, but is there at least a medium term plan or something?
So we are a large country which imports essentially almost all our energy needs, at least the oil needs. So given how dependent we are on foreign oil, we are obviously heavily dependent on international fuel prices. In the long run, you can do many things, whether it's unconventional energy sources and various other things, maybe try to improve our efficiency, increase exploration for petroleum inside our territory. Many other things can be done. But any short to medium term, frankly, other than at the margin doing some hedging, there's very little we can do. Again, building up reserves for a large country like ours, how much reserves? Sure, just like with hedging, for short periods of time, yes, we can sort of get away with it. But this is not a structural solution to our problem. This is, at the margin, yes, something.
Some of the RBI reserves can it be considered an oil?
No, I would not recommend that a good thing. Yes, the gentleman here and then the gentleman there. Yeah, the lady here first.
Yeah.
Yes.
Hi, this is I'm Richa Pathak from L&T. My question to you is, if we see India's size of shadow banking with respect to NBFC sector appears to be on the higher side when compared to many other G20 countries. As per the estimates, and this estimates, I have basically read it from the survey report of Basel, Switzerland-based FSB report, the Financial Stability Board report. So what do you think, RBI keeping in view the PNB and the ILFS episodes, thereby avoiding such episodes, is likely to come up with some stricter guidelines, regulations, to ensure that such incidents, crisis doesn't happen? And if so, what's your perspective on this?
Certainly the very rapid expansion of the NBFCs in recent years is something we need to pay attention to. They are now systemically important, as we have just found out. And so we need much more, first of all, we need to have better data, transparency. Just like we have credit numbers for banks, we should actually have credit numbers that use, including NBFCs as well. And this, basic data doesn't exist. It's because we didn't think they were systemically important, but now we do, and we know this. So we need to pay much more attention to them. Secondly, yes, we do now begin to have to think about having regulations for them, because effectively there are very good reasons why we have regulations on banks. But if these non-banks are deposit-taking, they are a large part of our economy, and during periods of credit stress like we had recently, maybe they require also for the central bank or to act as some direct or indirect form of lender of last resort. If these are the kinds of expectations that we may be thinking about, then certainly we also need to then consequently on the other side begin to thinking about imposing much stricter transparency, regulation, leverage ratios and so on, on all of these, particularly if we decide that maybe while it may not be practical to go through every tiny NBFC in the country, but certainly on the larger systemically important ones, and then we may need to have rules about what is systemically important and then impose them. So this is a serious discussion that needs to be had. Incidentally, by the way, we are not the only country with this problem in G20. China has a much more serious problem of the same problem. And if we don't do it, on the other hand, we will have, the thing that you'll be constraining the banks, but the problem will simply be flowing through to somewhere else. So since there's no point in having this escape route and causing the risk in the system to go somewhere else, into the unregulated part of the system, and be very happy that you've got this heavily regulated but not expanding banking system. So this is the context in which we have to take this seriously. Yes?
Yeah, and secondly, how do we keep a check, not we, as a central bank, or for that matter, how do they keep a check on the gatekeepers of the country in India, especially?
Gatekeepers?
Gatekeepers of our country. So gatekeepers comes,
I thought they were the army.
The CRAs.
Sorry, CRAs?
The credit rating agencies, the external auditors. And
yes, of course, we need to have a serious conversation about the credit rating agencies, yes. I was surprised they called the gatekeepers, but anyway. Anyway, that is something you need to discuss with the central bank, who may be right now quite busy. It's over. And can you tell me what happened? And? Oh, details are not out yet? Okay, well, fine. Anyway, there's somebody there who wanted to speak, and I think I'm going to stop after this because frankly... Oh, well, how unexciting, but anyway.
So I was very excited to hear you that we have plans to get into global bond index, etc. But right now we have various...
Don't get too excited, there's some work to be done.
Where is this roadmap? So there are a lot of rules as to what tenor people can invest, they cannot invest. A lot of rules on what they can do to hedge their interest rates or currency risk, which makes it, there's a very vibrant market outside India for Indian linked products actually. So any thoughts on how to work and
obviously this is a whole, it's well late in the evening where I won't get in bore the audience with the details. It is a fairly technical area, but we are now getting into the real, and this is an area where you really need to know the nuts and bolts and which button leads to what. So we are working those things out. We will probably move a little faster on the equity side than on the debt side, but the debt one too. I'm afraid I'm going to have to stop because I can see some people at the back beginning to look longingly at the dinner. So with that, let me say, ladies and gentlemen, it's been a pleasure. Thank you.
Thank you very much, sir. Starting from the basics of economics to the art of catching frisbees, and then to the thinking about that's gone behind the GST and the IBC and the monetary policy. Thank you very much. I now request the Chairman Fedai, Mr. Jenna, to please give a small memento to Mr. Sanyal on behalf of Fedai. Thank you very much, sir, for having come here all the way. I now invite Mr. Gopi Krishnan, Vice Chairman Fedai, to propose the vote of thanks.
Good evening, everyone. It's my privilege and great honor to propose the vote of thanks on this memorable day. First and foremost, I would like to thank our chief guest, Mr. Rajneesh Kumar, Chairman SBI, who's not there right now with us, who's, despite his busy schedule, has found time to grace this occasion. His views on the current issues faced by banks were insightful. I also express my heartfelt thanks to our keynote speaker, Mr. Sanjeev Sanyal, Principal Economic Advisor to MOF, Government of India, for his candid views on economy, policy, and thought process of government in these challenging times. Of course, we all enjoyed his analogy on with respect to dog and frisbee. Thanks a lot, Mr. Sanjeev. I would like to thank a special mention here to Mr. H.R. Khan, who's been our guide for last 2 decades, sir. Thanks for being here. None of these Fedai or FIMDA conferences will end without saying thanks to you, I guess. Thanks a lot. I would like to also thank Mr. Chauhan, BSc, for supporting Fedai for conducting an option training during this year. Thanks a lot, Mr. Chauhan. My deep gratitude goes to the CEO of Fedai, Mr. Ashwini Sidhwani, and his team here, who have for having worked relentlessly over years for the development and smooth functioning of FX markets. Thanks a lot, Mr. Ashwini and team. Maybe we can a round of applause for them. Finally, let me extend sincere thanks to my fellow members of Fedai and my dear friends in foreign exchange market. Not only they endured the excessive volatility in INR, they also endured this vote of thanks speech from me. Thanks a lot. All the very best for the rest of the year and for 2019. Once again, thanks everyone for making this a grand success. Can I now request all of you to please join us for drinks and dinner? I think all of us were waiting for this, as Mr. Sanyal was hinting. Thanks a lot.